for this week, and we will have our last class on Thursday for this week. So on the agenda, I've just welcomed you. I have some announcements, nothing new. It's kind of old announcements. And then we will continue this battle with chapter 2, where we are dealing with gross income. And as usual, you may ask questions as we continue. So let's jump straight into the announcements. And the first announcement is that you are required to do your quiz 2. Your quiz 2 is currently open on e-learning, and you have 5 attempts. The pass rate is 3-1, and you need to do it before Friday evening. I hope that by now you've at least registered 1 attempt, and if you haven't done so, then you should do it immediately after class. Make sure that you at least register 1 attempt so long. Remember that there will be no makeup quizzes. And these quizzes will contribute 8% towards your final CA mark, and that is why it's important that you attempt all of them. And as mentioned yesterday, the first quiz didn't go as planned, I think, for most of you. So this is an opportunity for you to redeem yourself, to actually improve and to get a good mark for this one and going forward. Now that was on the announcements. If you have any questions relating to the announcements, you may ask those questions now. Any questions or anything that you want to say, you may do that. Any questions? All right. In the absence of questions, we will continue with point 3, which is we need to continue with our lecture on gross income. Now, guys, I want to show you here. Currently, we only have 30 attendees in this class. You guys are supposed to be 96. I have actually noticed this in the past few days when we had class. The attendance is going down drastically. And remember the 3 reasons why people fail at NUST. Those reasons are, or the 3 factors are, class attendance, attitude, and homework. And that is across all your subjects, not just this course. This is for all your courses. If you fail a quiz or a test or any of those things, just know that it might have to do with any of those 3 reasons. It is worrisome that students don't attend these classes. It's a lie that you feed yourself when you say, I will not attend class today because I will listen to the recording. That is a lie from the devil. You will not catch up. You know this. You will not catch up. That is why it is important that you attend the live lecture so that it is actually out of the way. You, as a student, cannot have anything more important than your studies. Your studies should be the most important thing. Anyway, let's continue with our lecture, and I want to get straight to the point where we've ended yesterday. Just a recap of yesterday's work. Yesterday we spoke about non-natural persons being residents, and we said that there are 2 tests: place of incorporation established or formed, and also, where they are incorporated, established or formed, and also place of effective management. What is very important is that we said that the place of effective management is at level 3. That is where the day-to-day business activities are carried out. However, on the backdrop of that, remember that I said these rules are currently being reviewed because of digital taxes. Now, guys, in terms of the 4th industrial revolution, we look at robotics, just where this world is actually going at the end of the day, and therefore we also need to look at the digital tax as aspect, which has a lot to do with forex trading, Bitcoin mining, and all these things. And those things were not incorporated in 1958 when this Tax Act was actually drafted. That is why there are some amendments that will probably come soon. I know a lot of research is currently conducted in South Africa in terms of digital taxes, because we also need to look at how it will impact the tax base of a country. Then we look at this example, and then yesterday we said we are done with resident. We looked at the total amount in cash or otherwise, and we said the three court cases that we will look at there is the Latergan court case, the Butcher Bros court case, and also the Bromeria court case. Now the principles for the Latergan case, here we looked at, or we said that an amount should be given a wider meaning, and it's not just money that will be included, even if it is otherwise, even if it's an asset. And we also looked at corporal or incorporeal assets, or corporal or incorporeal. If it's corporal or incorporeal, then, and it has a monetary value, then we say it should be included in gross income. Then we look at the Butcher Bros. Here we spoke about leasehold improvements, and although this court case found that that amount should not be included in gross income, we say that the gross income definition was actually changed later with paragraph H that was actually brought into play. Now today we need to look at the Bromeria court case. So we've ended at the Butcher Bros court case yesterday, and today we need to look at the Bromeria court case. Guys, the assumption is that you've read through the court cases yourself, because you will be assessed on them. You should know them. Those court cases, you should know the facts, and you should know the principle, and also what did the judge actually found. Now, Silas, please mute your microphone. And in the Bromeria court case, oh, you have a question? Okay, let's listen. Talk to us.
Question is regarding the taxpayer. Let's say if they inherited an asset from their relatives, let's say a car, they inherited a car. Will that car also be included in the gross income? The value of that car, actually.
Yes, thank you, Silas. So yesterday, I think I've used that example where I said, let's say your mom gave you a car because she's proud of you, and your question is, will the value of that car, let's say it's 100,000 rands, will that have to be included in gross income? The answer is yes. The answer is yes. Now, I know in financial accounting, we talk about it's an asset, and, you know, we distinguish between income, expenses, assets, liabilities, and owner's equity. But in this case, what we see it as is actually you receiving an amount. You've actually received an amount. You've actually received. So what I'm trying to say is we don't just include you know, amounts in our gross income when we sell goods, okay? Not just when you sell. You will even later see when we talk about fortuitous gains and even things such as what I can think of now. But anyway, so the short answer is yes. You will, if you can determine the value of that asset, it should be included in your gross income. Now let's have a look at the Bromeria court case. And we say an amount does not have to be able to be turned into money by the taxpayer to be an amount for the purposes of the gross income definition. So you see, guys, they basically say it doesn't have to be turned into money. So this is another court case that actually now shows another perspective of amounts that should still be included in gross income. The amount merely had to be in the form of an asset. I think there we have your question, or there we answer your question. The amount merely had to be in the form of an asset, which could be turned into money. if it is sold. Now, guys, what is very interesting in tax is sometimes you will pay tax on an amount and you didn't even sell that asset. You know this. In financial accounting, when we have a revaluation surplus, then you know you actually have to pay tax on that. In the other comprehensive income section, you calculate tax on that, and you know you actually didn't even sell that asset. You still have the asset. It's just that you did a revaluation, and yes, the value of the property was $1 million, but now it's 1.2 million. On the 200,000, that is the revaluation surplus, right? You have to pay tax. Now, it seems very unfair because I haven't sold the property. I just did the revaluation, but I have to pay the tax. So I think that is probably the best example that I can give you, is that we say that if you were to sell that asset, then actually you have to pay the tax. So merely had to be in the form of an asset, which could be turned into money if it was sold. Now, guys, in this Promeria court case, the facts were that it was residential units in a retirement village, but basically how it worked was, so the tenants had to pay a deposit or had to pay an amount, and then they got the right to live in these residential units at the retirement village basically until they die. So they had the right to live there until they die. And what the judges found was that amount that they paid. You see, sometimes lawyers and these people, they are very creative with the terminology that they use. So they actually said that it is a interest-free loan. Now, guys, just to give you the background, generally a loan amount should not be included in gross income. Now, can one person quickly tell me why should we not include loan amount or money that you borrowed in gross income? Quickly, tell us. A loan that you take from the bank, why should you not include that amount in your gross income? Yes, talk to us.
Doesn't decrease your liability.
Can you just repeat that?
It's because it doesn't decrease your liabilities.
It does not increase your liabilities. Is that what you're saying?
Decrease.
It does not increase your liabilities.
Because you have to repay the loan back, so it can't be included in the gross income.
All right, so let's listen to Denver. He said because you have to repay the loan, it should actually not be included in gross income, and that's the answer. That is the correct answer. It never belonged to you. It does not belong to you. That principal amount. Now, guys, it's very important with a loan. You need to distinguish between the principal amount and the interest, because the interest is another story. We will talk about that shortly. But yes, like Denver said, that money does not belong to you. And guys, later in this lecture today, hopefully, you will see that if it actually didn't, if you are not entitled, if that money does not belong to you, then it is actually not gross income. Now, my next question is, how about the interest? So we've distinguished and we said the principal amount, since I'm paying it back to the bank, do you see it doesn't belong to me? But what about the interest? Will the interest be deductible? Let's ask that question. If you pay interest on that loan to the bank, will that be deductible for tax purposes or not? One person to try.
I'll say that will depend.
All right, you said it will be deductible. Why? Let's get the logic. Why do you say it will be deductible?
I say that would depend. If a loan is a personal loan, then it will not be deductible. But if it's a loan for the business, maybe to cover business expenses, then I would say maybe to be deductible. All
right, you are on the right track. So just tell the class, why do you say that? Because you are correct to say that if it's like more on a personal level, personal loan, then it will not be deductible. So what is the rationale there? But if it's for business purposes, it will be deductible.
Where I'm saying it's when it's for business purposes to be deductible is because it's part of business operations, so it will have to be deductible. It's part of the day-to-day business activities. Normally, business get loans to fund their activities here and there.
All right. So I like your last sentence where you said to fund its activities. So it's in the production of income. I needed to obtain that loan so that I can actually make money. You know, in normal business in a normal business setup, in order to make money, you have to spend money. That is why you guys should never listen to these people that tell you you don't have to do anything, you don't have to pay anything, but you will make money. Don't listen to. As an accountant, we don't do that. It is responsible thing to believe these people, because in any business setup, you have to spend money to make money, or if you don't spend money, you have to at least put in the hours. You at least have to spend time on that thing. So in most cases, they will tell you, especially these M-way, sometimes I also get the feeling from what is it, Herbalife and these people, they say it's your own business, you don't have to spend money and you don't have to spend time. It's a lie. It's a lie. You have to actually get clients and sell these things. But anyway, let's continue. We are off point. So yes, guys, the interest, I just wanted to say that the interest will be deductible. The principal amount, no. The interest, normal expense, so it will be a deductible expense. And guys, in financial accounting, you were taught about finance costs. So finance costs, that is interest, isn't it? That is a normal deductible expense. So yes, guys, just back at the retirement village, so they actually said, give us an interest-free loan. This is now the developer who said this. Let's say, give us 500,000 Rand interest-free loan. So you see why I'm saying creative, very creative, because if you use the word loan, then it seems like they have to, or the developer have to pay back that money to that elderly person. However, that was not the case. They had to pay that interest-free loan, or as they call it, and then they had the right to live there until they died. But that money was never paid back. And the courts found those interest-free loans should be included in gross income. That is what the courts found. The courts found to say that is actually, I think what the courts wanted to say is, that is actually not a loan. You want to call it a loan, but it's actually not a loan, because the person actually get the right to use this asset, this retirement village, and they actually paid for it. They actually paid for it. So there's a total amount in cash that they actually get. And the fact that they get otherwise, which is the asset, but all of these criteria were met. And that is why the courts found it to be gross income, and they had to include, the developer had to include all these interest-free loans in their gross income. Guys, as a general rule, like one of the students said, loans, the principal amount, you don't have to include it in gross income. In the Bromeria court case, the interest-free loans had to be included in gross income, but I just gave you the background why that was the case. These were actually not loans, as they used this terminology in their contracts or whatever. These were actually not loans. It was actually received by the developer. Now let's have a look at an example. Mr. Wright is a lawyer and performs legal services for a client. The fees amount to 15,000. The client settles by giving Mr. Wright a flat screen TV with 20,000. Now guys, the question is, what should be included in gross income? 15,000 or 20,000 Namibian rands? Which amount should be included? Now guys, as you can see there, you will have to include the 20,000 Rand into Mr. Wright's gross income, because that is what the TV is worth. That is what the asset is worth. Even though these people actually only owed Mr. Right 15,000. They've given a TV with 20,000, and you need to pay tax on the total amounts received, not just the amounts received, but the total amounts that you have received. Guys, I hope this makes sense, that you don't just pay tax on the 15,000, you have to pay tax, or you have to include the gross in your gross income, the full 20,000, what the value is for this TV. And that brings us to the next element of gross income. So yes, guys, we've looked at total amount in cash or otherwise. Now we will look at received by or accrued to or in favor of. And this will also make a little bit more sense. This 5,000 difference that they've received, this will also make a little bit more sense once we are done with this component. So indeed, the next component, received by or accrued to a taxpayer. Now guys, you know in financial accounting, we can actually have a cash transaction and an accrual at the same time. Let me give you an example, for instance. Let's say we buy goods, it's 10,000 rands, okay? So we pay 5,000 rands now, that is in cash, and then the other 5,000 we will pay, let's say, in only next year. Do you see that both of it happened at the same time? There's a cash transaction, or not cash transaction, but there's a cash component, and there is an accrual component. In tax, we say you have to choose. Yeah? So they say either received by or accrued to. One of the two. It cannot be both. For tax purposes, it cannot be both. So it cannot be, because if it's both, then there is there's actually an opportunity, or not an opportunity, there's a possibility for you to double count that amount at the end of the day. So what will we then do in terms of received by or accrued to? We will include it at the earlier of receipt or accrual. Guys, what this statement just means is whichever one happened first, that is the one that we will have to include in gross income. What do I mean with that? If I receive the money, if I receive the full amount, obviously I'll have to include it. That one is always easy. But if there's an accrual, if the accrual occurs first, then we say that you will actually still need to include that in gross income. Let's just read here quickly. The phrase suggests that it must be either received or accrued. So it should be one of the two. It also means that it does not need to be both received or accrued. In most instances, receipts and accruals occurs at the same time, but it can happen that an amount is received before it actually accrues, and the accrual before receipt. The commissioner does not have a choice as to when to include the amount on either receipt or accrual. He must include it at the first of either receipt or accrual. So guys, what I'm trying to say is in financial accounting, you can have both at the same time. While tax, we say one of the two. It will make a little bit more sense as we continue. Let's look at receipt. So receipt or received by, there were some court cases, and the first one there is the Geldenhuys versus CIR. So this Geldenhuys versus CIR court case, and this court case had to do with some sheep. So the principle there, and just for the sake of our time, I will not open the court cases. I'll try to give you background of these court cases. So we say an amount, the principle that was laid in the Geldenhuys court case is that an amount is received by a taxpayer only if it is received by him on his own behalf for his own benefit. So very important, guys. Remember what we said earlier with a loan, that is actually not your money. That is, it doesn't belong to you. So it's not on your own behalf. Yes, you got the money, but you have to repay it. So if that is the case with a loan, you don't have to include it in gross income. And this was found in the Gelderhuys court case. We only include an amount in gross income if you as a taxpayer receive the money on your behalf and for your own benefit. Let me give you another example. Let's say I owe Silas 10 rand, okay? But I give the 10 rand to Denver to deliver to Silas. Then Denver doesn't have to include that 10 rand in his gross income because that money never belonged to him. He didn't receive it for his own benefit. He's basically only an agent. He only need to give the money to Silas. I hope you guys got that. So the money, yes, Denver did receive the money, but he didn't receive it for his own benefit and on his own behalf. Then the MP Finance court case. Now here we look at illegal or the legality of receipts. So what was found in this court case is even though the receipts are illegal, they are still received and therefore gross income. Now guys, just to give you background for the MP Finance court case, here they actually it was a pyramid scheme where people were actually told, remember, a lot of you also fall for these pyramid schemes where someone, stokvel. Let me give you the best example. Last year, we had stokvel during the whole pandemic. So basically what happened is you need to give money and apparently you will get more money. But you know that the Bank of Namibia actually declared it as a pyramid scheme. Now, in the MP Finance court case, it was kind of the same thing where people were promised. Now, guys, the emphasis is there on this wording. They were promised significant profits. Yes, significant profits. And normally, when you hear these terms, just know it's too good to be true. So what happened was, people gave their money, and at the end of the day, MP Finance ran away with people's money since it's a pyramid scheme. And then MP Finance did not want to include that money in their gross income. So they did not want to include it in their gross income. And their argument was, I did not receive that money for my own benefit on my own behalf, but in this court case, it was found that MP Finance actually had to include it in gross income. Why? Because the intention was never to actually pay back the money to the people that they've actually scammed. And therefore, they say that even though the receipts was illegal, illegal receipts, they still had to include it in their gross income. Now, guys, my next question is, what about when you steal money? Let's ask that question. If you steal money in South Africa, let's say you steal 100 million from Standard Bank, will you have to include that in gross income or not? Or let's bring it a bit closer to what happened recently, the looting in Durban. So some of the people actually took the cash from ShopRite, from the tills and all of that. So do you think those amounts that they actually, they stole the money, right? Looting. Do you think that should be included in their gross income or not? Now, bear in mind, before you answer, bear in mind that those were mostly residents of South Africa, and residents pay tax on their worldwide income. And we just saw that with the MP Finance court case, that even though it was illegal, the pyramid scheme, these people still had to include the gross income, still had to include the receipts in their gross income. Now, please bear in mind all of this and answer me. Do you think those people should have included that amount in their gross income, or they should include in the 2022 year of assessment? Just try. What do you guys think? Stealing of money. I'm waiting, just try.
So let me try.
Yes, Silas, let's listen.
One thing we should think of, I think, it will depend whether we know how much. Let's say there's 5 people that we know that have stored money. One thing that we first have to ask ourselves is whether do we know how much each of those 5 people store the money, how much of the money they have stored.
Okay.
Yeah.
So which law is that? Is that now your own law that say you must know first how much?
Not
Remember in terms, yeah, Silas, I got you. Remember in terms of the gross income definition, there is no story of how much. In fact, we did earlier, in the earlier element, we said if the value can be ascertainable, if it can be determined, then it should be included in gross income. And maybe I can then give you this fact to say that the banks actually came out and they actually did some estimates to say what was the total value that was actually stolen. Yes, it doesn't show how much did each person actually steal, and I think you are arguing from the perspective of the taxpayer to say, but they can't prove how much money I actually stole. But remember, as a citizen, you need to, as a citizen of South Africa, you need to pay tax on your worldwide income, and it's your responsibility. The onus rests up on you to actually declare your income and all of that. So if you don't do that, then I know you. The next thing is probably, but they won't do it. We know these people won't do it. But in actual fact, in terms of the act, in terms of the Constitution, actually, is that you are supposed to declare all your monies and all of that. If you don't do it, then you are actually busy with a criminal offense. So let's say, for argument's sake, someone looted 10,000 rand. So I'm giving you an amount. Do you think it should be included in his gross income? So, let's say Mr. X, let's make it a bit more specific. Let's say Mr. X looted 10,000 10,000 rands during the whole Durban and KZN story. So will they have to include it or not? Anyone else? Or Silas?
I think
Answer.
Yes, talk to us, to the lady.
I think it should actually be included because I think it should be included in the gross income.
Why?
Legally, it should be included.
Why legally? I thought stealing is illegal. That's why they locked up
Stealing
people.
is illegal. Stealing is illegal, but then your income actually should be included in the gross income.
Now
Any
I like your
income
argument. So what she is saying, thank you. I'm hearing what you are saying. What she is saying, irrespective, and I like how you actually take the one away from the other to say, listen here, yes, stealing is illegal, but in terms of the tax act, income tax act, whether it is legal or illegal, that money, you need to include it in gross income. And that's what I got from you. Someone else that want to say something quickly? Anyone? All right. And guys, in this case, I want to specifically bring you back to on his own behalf for his own benefit. And you will see that later, that you should actually receive that money for your own benefit. And guys, what they found, let me just open that court case. What they found for stealing money, it is actually said that such an amount should not be included in gross income because of bilateral receipts and unilateral receipts. What do we mean with that? So they say it is submitted that theft will usually not be gross income as it is a unilateral receipt. Now, what do we mean with unilateral receipts? It means So they say taking money doesn't mean it has been received by you, as it was never given to you in the first place. So just to round up, to wrap up that argument there, you didn't receive it for your own benefit. Someone, or you didn't actually, I almost want to go as far as saying, someone didn't give it to you for your benefit. In fact, you actually took it by force. You actually took it in an illegal way. So just to come back here, the whole argument of received by or accrued to, we need to look at, did you receive it at your own benefit and for your own behalf? Now, guys, don't get confused with the MP Finance argument, where we basically said that the fact that it's illegal, this whole pyramid scheme, they still had to include the growth it in the gross income. So to answer you in terms of the looting, so technically, like the lady said, technically we are actually saying that these people did not receive that money for their own benefit, and therefore they didn't have to include it in gross income. In fact, you can even then conclude to say that other avenues of the Constitution should be explored in order for these people to actually pay for what they did. But in terms of for your own benefit, they didn't receive it for their own benefit. In fact, they took it by force. Then, guys, the last one is the Delagoa Bay cigarettes court case. And here, guys, once again, there was some legal versus illegal aspect that needed to be looked at. So, and they found in the Delagoa Bay cigarette court case that the legality of the receipt does not preclude it from tax. Now, guys, just to give you background again, in terms of this court case, they sold illegal cigarettes. Okay. Now, this is interesting again, because I'm sure by now some of you will ask the question, so should receipts now be included in gross income or not? That is illegal. In this case, they sold illegal cigarettes, and they decided that they should not include the money that they made from the illegal cigarettes in their gross income. However, the courts found to say that they should actually include the money that they made from selling those illegal cigarettes. They should actually include it in their gross income. And basically, the principle that was established was that the legality of the receipt does not actually preclude it from tax. And this was in this specific court case. Basically, what they said is, like our lady, and that's why I said earlier that I like how you actually split the two. In this case, even in the example where I gave you about KZN, I told you they should actually explore other avenues. Now, it was the same in this Delagoa Bay cigarettes court case. Yes, they had to include it in gross income, and they said that the legal aspect, you know, the other acts, you know, environmental act, food act, whatever act, they must now take it up on them to actually punish these guys in terms of why they actually selling illegal cigarettes. Guys, in Namibia, for instance, just on that matter, there is this one cigarette type that is sold in Namibia. I think it's called Yes. It is illegal, but I know people actually sell it in Namibia, for instance, and that is just to relate it to this whole court case. So if it was South Africa, if they sell illegal cigarettes or whatever in South Africa, the receipts, the money that you receive must actually be included in gross income. Now let's look at the Pyatt Limited versus CIR court case. Now guys, this is an interesting one. Normally, before COVID, when I actually went to watch Namibia play rugby at the, you know, at the Hagegeingob Stadium, one of my colleagues and also one of my friends who's a lawyer, we used to one day randomly, we just sit there and we spoke about the Payet court case while we were watching the rugby, because this one is so interesting. This one had to do with cookies, biscuits that was actually sold in a tin. And I know that many of you guys know, if you have a grandma, you've probably seen these big tins where there was actually biscuits in there. I know that these days they don't put biscuits in there. You will get a very nasty surprise if you open it, that there won't be biscuits. But anyway, so in this court case, what happened was they basically sold the biscuits with the tin. However, people had to pay extra for the tin, okay? They had to pay some dollars or rands extra for the tin. And then if you returned your tin, then you got your money back. Okay, let me put this in a scenario. Let's say the biscuits is 20 rand, okay? So you had to pay 22 rands, okay, for the biscuits. And then if you return this tin, then you got the 2 rands back. However, guys, what is important to establish in this court case is that it was not compulsory for you to return that tin. You could either decide to return it or not. Like with empties in Namibia, for instance, bottles, beer bottles or cool drink, when we used to have those glass cool drink bottles, you could actually return it and get money for that. However, guys, it is not compulsory. It is not compulsory. So what was found in this court case, they basically, the Payet people, they actually said that the money, the deposits, that 2 rand that they got extra, they said that that money should not be included in gross income because they had to refund their customers once the customers bring back the tin. However, the courts found to say deposits are revenue in nature arising in the ordinary course of trade. So what the courts actually found was, the court said those 2 rands, every 2 rand that you receive, you have to include it in gross income. The reason for that was the fact that it was not compulsory to pay back that 2 rand. It was not compulsory. If someone doesn't bring back the tin, then they don't have to pay the 2 rand. And therefore, the court said you actually have to include all those 2 rands in your gross income. So the courts actually found deposits to be revenue in nature. And since in this case, since it was not, there was not a condition, it was not compulsory for you to actually return the tin for you to get the money, the court said that the money should be, the deposit should be included in gross income. Now, in the CAR versus Witwatersrand Association of Racing Clubs, there's another court case. Okay, there's a question. Let me quickly listen. Yes.
Does this Payet LTD versus does it relate to the deposit for rent?
Does it relate to the deposit for? I didn't hear the last word.
Rent.
Aha.
Like for people.
Yes. Let me talk a little bit about rent. I actually wanted to talk about it in another slide. I think that is up, that is still coming. But yes, so let's talk about rent. So you see the issue here, and that is why I've actually mentioned this over and over. The issue here is that there was no condition. Okay? Or what I said was, it was not compulsory for these people to return these tins in order for them to get the deposit. And that is why it was included. However, and remember with lease agreements, you get a security deposit and you get a non-security deposit, okay? Security means you will get it back. And I think those are the lease contracts that most of you enter into, where you will actually get your money back after you leave. Now that is a different story. And I want to conclude by saying, generally, deposits that is conditional, what do I mean with conditional, that will be paid back, will not be included in gross income, because you didn't receive it for your benefit. It doesn't belong to you. You actually need to pay it back. But if it is an unsecured deposit where we say it won't be paid back to the person, or where in this case it's conditional, it's only going to be paid back if they bring the tin and all of that, then we say that now seems like you actually received it for your own benefit, and therefore you need to include it in your gross income. Did I answer your question? Any follow-up question?
Yes, sir, I get it now.
All right, thank you. So guys, I think the important thing that you need to notice is in law, oh, is there another question? Yes, Sila.
Yeah,
Go
regarding
ahead.
regarding rental, let's say NSA, or even here in Namibia, let's say, when they seek for tenants, for instance, for their rental facilities, they pay deposit. And let's say, for instance, that deposit can only be repaid back to a tenant. Maybe if they want to leave and they inform the landlord in advance that I will leave maybe month end, that's only when the tenant is to, I mean, the landlord will be able to maybe pay back that money. But let's say if a tenant just by tomorrow and just like he just told the landlord just urgently or just immediately that I'm leaving now or I'm leaving tomorrow, like that, there's no way you like in that condition now, will that amount become will that amount become or belong
No,
now to
I think I get your question. So my question to you is, yes, sorry, I got it. My question to you is, so it seems like there's a breach of contract. Yes, you said you will go end of the month, but now you have to, due to circumstances or whatever factors, you have to go tomorrow already. Is that what you were saying?
No, they didn't breach any contract, but it's just that he didn't inform. In that case, he didn't inform the landlord in advance that he's going he's going after some time. He just informed me immediately that I'm leaving now or I'm leaving tomorrow.
I get you. What I can tell you is what you are talking about is definitely a legal issue. So what he was saying is the person just leave. Okay, let's say for argument's sake, the person died of COVID and he didn't have any family or whatever to come claim that money, and now that money is actually in the hands of the landlord or something like that. So your question is, does that money then belong to the landlord? Does that money now belong to the landlord? And do you see why I'm saying this is now a legal issue? Because clearly they have to look at your estate, because technically the landlord owe you that money, and it actually doesn't belong to the landlord. But let's say for argument's sake, nobody claimed that money from the landlord, nobody know about it. Let's say your lawyers doesn't know about that money and all of that, and it is now just there in the landlord's books. So for tax purposes, there are two things that we need to look at, and the first thing is, what is your intention with that money? Clearly, you will tell us, listen here, this person is not coming back. I don't know where to locate them. I have the money here. So we need to look at what is your intention with that money. If you tell us, since I can't find them, I'm going to use this money. Immediately, if that is going to happen, if there's a change of intention, then we say it will be gross income for the lessor. But let's say that the lessor say, I will not use the money because I'm scared, at least for 10, 20 years, I'll just keep it here. Then it will not be gross income. I hope I've answered you, Silas.
Yes, thank you. Yes, thank you.
All right, let's continue. So guys, what I wanted to say with these court cases, you must always remember, yes, we will look at the principles, and your court case for your client might be similar, but it will never be the same. So yes, we can look at these principles, but this principle doesn't necessarily mean it will also be applicable to your client's scenario. And that is why we just use these court cases I almost want to say, just go through the principles and see how it's similar to your client scenarios. But it's never black and white. What was found in the Pyatt case, and your client might not even have the tins. Let's say it's now even glass or something like that, like the empties that I spoke about. It will never be the same facts, but it can be if it's similar. And at the end of the day, it is up to the courts and up to you to basically convince the court that an amount is gross income or it's not gross income. And you will see later when we get to capital amounts. Now let's look at the last court case, Witwatersrand Association of Racing Clubs. So guys, just to give you background for this court case, in South Africa, horse racing is a big thing. They even have what we call Durban July. Every year in Durban, there's a huge, these days it has become actually a more of a fashion parade, or even a glamorous event where you will find Miss and Miss South Africa and these people, and then who's who of who will be there, and people are just dressing up. But anyway, horse riding is big. That's what I'm trying to tell you. So much so that there's even an event every year called the Durban July, where horses just compete against each other, and there are big money at stake. So guys, what happened in this case, in the Witwatersrand Association of Racing Clubs, it was horse racing again, and basically the Witwatersrand Association of Racing Clubs, they said that they will have a horse racing competition on Saturday, and the money that they will receive by or entrance fees and all that, they will actually donate this money to charity organizations. Now, this court case came about because they actually now received the money, and when they received the money, they said that clearly that money should not be included in their gross income, because they will donate this money to the charity organization. However, CIR, Commission of Inland Revenue, was of a different opinion, and the courts actually found that once income has accrued to you, subsequent disposal thereof is irrelevant. So basically what the courts found is they received that money, you know, entrance fees and sponsorships and all of that, and the court said they have to include it in their gross income. Them arguing to say, listen here, the money doesn't actually belong to us. We will actually donate it to a charity organization, and that is why we will not include it in gross income. The courts found that argument not to be valid. The courts actually said subsequent disposal, what you do with the money afterwards, is irrelevant. You have received it, or it accrued to you, and therefore you have to include it in your gross income. Do you see, guys? Quite interesting, all of these things. Now, guys, I see that we've actually, let's do this one quickly, and then on Thursday we will just continue with this. So let's look at accrue to. So far we've looked at receipt. So these court cases are all pertaining to receipt. Now we will look at accrual. Now in the CIR versus People's Store, now as this was a Walfish Bay court case, like I mentioned to you yesterday already, we are currently, Walfish Bay is actually noted as a court case in the South African tax law. Now guys, in this court case, what happened was it was a retail clothing company, and they gave people a 6 month to pay. So they had a credit scheme where they allowed their customers to buy on account, and then they had to pay, or they had 6 months to pay. And the argument was, since the People's Store didn't receive that money yet, should they include it in gross income or not? And guys, what was found in this court case is accrued means to become entitled to. So for tax purposes, what was found in this court case, accrued means to become entitled to, and then they said that the accrual should always be at the face value and not at the discounted value. You know, guys, in financial accounting, we always calculate the present value. You guys know this, the present value and all of these things, especially with leases and all of that. In tax, we say you have to use the face value, the actual amount that transaction is today. So don't discount it. You have to use the actual amount. So the face value and not the discounted value. Now, guys, the later gaan court case is here again with the accrual. And basically, it also found that you are becoming entitled to an amount. I think, guys, the big thing between the Latergan, the difference between the Latergan and the People's Store court case is that this People's Store's court case also speak about entitled to, but it went further to say it should be at face value and not at discounted value. Latergan, in that court case, what was established was accrued also means to become entitled to. And then in the Mooi court case, Mooi versus CIR, here we dealt with share options. It was actually found that entitled to is not enough, guys. In this court case, they actually found that you should be unconditionally entitled to an amount. So there should be no conditions for you to receive that amount, and then you should include it in your gross income. An amount has not accrued to a taxpayer if it is dependent on a future event. And guys, in financial accounting, you know this is the case. When we talk about contingent assets and contingent liabilities, you know we don't include it in our statement of financial position or statement of profit or loss. You just bring in a note into the financial statements to say, yes, this is a contingent liability. What is a contingent liability? A future. It's dependent on a future event, a court case. The judge still need to rule or whatever the case might be, and therefore you don't bring it into your records. The same principle here. The same principle here is that we are saying that it should be unconditional. It should not be conditional. Just on that, before we wrap up, guys, sometimes you can enter into contracts where someone actually tell you, and that is basically with this Hyatt court case, where, just to add there, where we said if these people actually return the 10, then they get the 2 rand. Do you see that there's some kind of condition there, conditional, and we enter in a lot of similar transactions where someone tell you, let me just give you in terms of leases, IFRS 16, leases for financial accounting. Some of these malls, they will tell, let's say, Etters, you need to pay me 10,000 rand per month, plus 1% of your revenue, provided that you make 20 million per annum profit. Do you see that there's a condition there? I will only get the 1% if these people make a 20 million profit. So that is not unconditional. That is conditional. There's a future event that need to take place. And if there's a future event that still need to take place, then clearly you don't have to include such an amount in gross income. We can end there for today. We will continue again on Thursday. This is a very, very long chapter, but it's important that you understand it. Like I said, some of you would want to continue your studies. Guys, this is the end of our lecture. I believe you need to be somewhere else. Let me end the recording. We will continue.